This is a brief introduction to Dow Theory by Karen Jones, content creator for the Society of Technical Analysts. Dow Theory is a subject that's far more nuanced than we'll cover here. While the theory is named after Charles Dow, the former editor of the Wall Street Journal, it's a series of articles that he wrote in his editorials, and it's important to note that he never formally compiled it himself. After his death, these writings were collected and organised and later become collectively known as Dow Theory. So these are the tenets of Dow Theory. The first of which is the averages discount everything. The second is the market trends have three phases. The third is markets move in three types of trends. The fourth is indices must confirm each other for a trend to remain valid. Fifthly, volume confirms the trend. And lastly, trends persist until clear reversal signals emerge. It should be noted in the final one that both averages will need to give reversal signals for that to be valid. So let's move on with the first tenet. So what does the averages discount everything really mean? Originally, Charles Dow was referring to the Dow Jones averages when he wrote about this principle. However, in modern technical analysis, it's often rephrased as price discounts everything. But the idea remains the same. Market prices reflect all known information, be that economic data, company performance, political events, and investor sentiment. So whether you're looking at an index or an individual stock, the price itself is considered a comprehensive snapshot of collective market knowledge and expectations. Sometimes we see that a company, for example, will announce strong earnings, but instead of the price rising, the stock price falls. Well, why is that? Quite simply because savvy traders often buy in advance. They anticipate good results. So by the time the news is officially released, the positive outlook has already been factored into the price. Many traders then choose to actually sell and take their profits, causing the price to dip despite the good news. In other words, the market has already priced in the earnings. Many technical analysts believe that a technical analysis is possible because of Dow theory. If price reflects everything, then studying price movements, i.e. charts, trends, volumes, can reveal market psychology and potential future moves. When Dow talked about three phases of market trends, he was actually talking about an accumulation phase where informed investors, which are often called smart money, begin to buy quietly before the broader market catches on. Prices just move steadily and slowly, and sentiment is often cautious. A second phase is the public participation phase. That's when the trend becomes more visible, the news improves, technical indicators confirm the move, and most investors start to jump in. This is typically the strongest part of the trend. And lastly is the distribution phase. This is when smart money starts selling to lock in their profits. Optimism is high, but momentum fades. Prices may still rise, but the trend is nearing exhaustion. Markets move in three types of trends: primary trend, secondary trend, and minor trend. Now, for primary trends, this is the dominant long-term movement of the market, either in an upward or bull market or downwards in a bear market. It typically lasts from several months to multiple years and reflects the broad direction of price. Secondary trend, these are temporary corrections or counter moves within the primary trend. They usually last weeks to a few months and can retrace a proportion of the primary trend. For example, a pullback during a bull market or a bounce during a bear market. Lastly, the minor trends. These are short-term price fluctuations that occur over days to weeks, and often they're driven by news, sentiment, or technical factors. Minor trends are considered to be noise within the broader market structure. And if you'd like to think of it in the following way, primary trends could be considered the tide, secondary trends could be considered the waves, and minor trends could be considered just ripples. Indices must confirm each other. For a trend to be considered valid, both the Dow Jones Industrial Average and the Dow Jones Transportation Average should move in the same direction. This confirms that economic strength is broad-based, i.e., goods that are being produced are also being shipped. Volume confirms the trend. Rising volume adds credibility to a price move. If prices are climbing and volume is increasing, it suggests strong investor commitment. But if prices rise on low volume, the market may lack conviction and this move could well be short-lived. Trends persist until clear reversal signals emerge. A market trend remains in force until there's a clear and confirmed signal that it has reversed. Dow Theory actually discourages guessing tops or bottoms and suggests waiting for evidence before declaring a trend change. Ideally, both indices will show signs of reversal. To update that slightly, if you think about, for example, the US dollar and you think that it may have based, you need to check that that basing pattern is still evident versus the euro, versus the Swiss franc, and versus the Japanese yen as well. A top tip someone once gave me is that if you're convinced a market has topped, turn the chart upside down and see if you feel if it's still a base. I always think that is an excellent suggestion. If you are interested in learning more about technical analysis, please go and have a look at the STA's website, the Society of Technical Analysts. It's at www.technicalanalyst.com. We have got a wealth of resources and experts at our fingertips. If you'd like to get some support and you can ask our team for some assistance, you can contact us directly. Thanks very much.